Yes, guys. So the very first thing that I told you beta in this unit of money supply, that money supply is a macroeconomic variable which in turn beta has a very good impact, a very big impact beta on all the other macroeconomic variables. So if you want economic stability as such, guys, there should be an optimum level of money supply. To know better as to what should be the optimum level of money supply as such, guys, first you should be in a position as such better to measure the money supply in an economy. You should be in a position better to measure money supply. This is what I told you better, that for economic stability better your money supply should be optimum. To know whether money supply is optimum or not better, the first thing that you should be do better is to measure money supply, and you should be better in a position to regulate it. When we use the word money supply, guys, we are basically talking about the total quantity of money better that is available to the public, better as a means of payment and as a store of value, as a means of value, payment, guys, and as a store of value. That is, it should function as a medium of exchange, guys, and as a store of value. Remember, guys, here when we say money supply beta, we are referring to it as a stock variable. That means we are talking about the quantity of money beta at a specific point of time. When we talk about changes in money supply over period, we refer to money supply as a flow variable. But unless otherwise beta, this is all a stock variable. That is, this is the quantity of money beta at a particular point of time. Also, guys, the word public here beta means all the economic units like households. It will include the producer sector, institutions, foreign central banks beta. It will include IMF. It will include public sector undertakings. It does not include the producers of money. Who are the producers of money in a country beta? It is the government, it is the banking system, it is the RBI. So any amount of cash balances lying with the government, amount of cash balances lying with the RBI, amount of interbank deposits are not to be included, guys, are not to be included beta in the definition of money supply. Understood, sir? What is the rationale behind measuring money supply as such better? See, you will be able to better analyze better your monetary developments, guys, so that you know the actual reasons for money growth. So this is all about analysis of those monetary developments, sir. Monetary developments matlab kya, sir? The amount of advances have increased, the amount of credit money has increased, guys. Why is the amount of reverse repo increasing? Why is the amount of repo transactions increasing? Why is the dollar rate come down? All of that, guys. And then it provides a framework better to evaluate whether the stock of money is consistent with the standards better for price stability. Are there any deviations from these standards? Sufficient hai nahi hai. For that better, you will have to measure money supply. Sources of money supply better, two important sources of money supply. One is high powered money as such better. The other one better is the credit money that is generated by the banking system. Credit money better that is generated by the banking system. So we say, guys, the source of money supply better will depend on central bank because of the authority that has been conferred on the central bank as such, guys. Second better, it would depend upon the supply responses of the commercial banking system, guys, basically in response to the variable changes, in response to, guys, the policy variables by the central bank to influence the total money supply. They say if the RBI beta is changing your CRR, cash reserve ratio, guys, are banks actually lending more money, or they holding excess reserves, are they parking money under reverse repo? All of that beta would determine the amount of the total money supply in a country. Now, when you say high sources of money supply, beta, when you say high powered money is monetary base, this basically as such beta is the currency issued by central bank beta, which becomes the primary source. This is the total currency that has been issued by central bank, and this would become beta the primary source of money supply. Primary source of money supply termed as fiat money. ठीक है? Earlier beta, it used to be 1900s beta, it used to be fully backed beta by gold and foreign exchange reserves, guys. But then we do not have the Gold Standard Act anymore, guys. So that is why beta there are only minimum reserves required to be kept. Credit money mein beta, I told you, guys, because of the deposits and lending, guys, because of minimum required ratio, guys, there is a multiplier effect that is created, which we will learn as a part of credit multiplier, guys. अभी के लिए बेटा, how do we measure money supply, guys? It is restricted to Indian economy only beta, whatever we are learning. From 1935 beta till 1967, there used to be only one measure beta that used to be reported, and that is narrow money 1. And that narrow money as such beta, and M1 as such beta used to be the total money currency with public as such beta plus the deposits with the banking system. Then their aggregate monetary resources beta started being reported, but from April 1977 beta we had M1, M2, M3, M4. M1 beta is the currency with the public. I repeat, guys, it is the currency as such beta with public plus the amount of demand deposits with the banking system plus other deposits with RBI. To this M1 as such beta, if you also add the demand deposits with post office savings bank account, you will get D2, guys. You will get M2 as such beta. To M1 beta, if you add time deposits also, that is fixed deposits beta, you will get M3 guys. You will get M3. Banks beta, RBI beta generally declares M3. Then beta M4 beta is basically M3 plus all deposits with savings bank account, except, I repeat beta, except guys, you are not supposed to include national savings certificate, because that is like a borrowing beta made by the Indian government. And then guys, other deposits with RBI matlab guys, demand deposits of non other financial institutions as such guys, foreign central banks, IMF, World Bank. ठीक है, हाँ सर. करेंसी विद पब्लिक मतलब guys, टोटल करेंसी इन सर्कुलेशन माइनस कैश रिजर्व्स बेटा दैट आर लाइंग विद द बैंकिंग सिस्टम. कैश रिजर्व्स बेटा दैट आर लाइंग विद द बैंकिंग सिस्टम. Understood, sir? Now, guys, if you talk about from 1998, beta, there were 4 new monetary aggregates and 3 liquidity aggregates, beta, that were reported by RBI. 4 new monetary aggregates beta are NM0, NM1, NM2, NM3. NM0 beta is the reserve money, high powered money, central bank money beta. This is basically the currency in circulation. Currency in circulation as such beta. What is the amount of currency with the public or with the banks? Plus what are the bankers' deposits with the RBI? Plus other deposits with RBI. If you talk about NM1 beta, it is the same as M1. NM2 beta is NM1 plus short-term time deposits. NM3 beta is NM2 plus long-term time deposits. Also beta call and term funding from financial institutions. But when we talk about L1, L2, L3 as such beta, L1 includes post office, L2 beta includes other term lending institutions, refinance institutions, L3 beta will include NBFCs also, NBFCs also. This is how you're supposed to remember them guys. These are the liquidity aggregates. Okay? Yes sir. High powered money can also be computed beta through RBI's assets. So you will write beta total RBI's assets plus government's currencies liability to public, that is beta in terms of coins, that is in respect of 1 rupee and small coins beta, minus beta RBI's net monetary liabilities, RBI's net non-monetary liabilities. Then beta I spoke about the concept of money multiplier. I said beta the change in high powered money, the change in monetary base as such beta will not be equal to the change in money supply. This is because of the multiplier effect beta that is getting created. I assume beta that none of the you know guys, households will hold cash. Everyone will deposit them in the bank. None of the banks hold excess reserves. They will hold only minimum required rate of reserve as such guys. So the multiplier as such beta, multiplier beta would be 1 divided by the required reserve ratio. That is credit multiplier beta or deposit multiplier. Deposit multiplier. Otherwise, normally beta multiplier is the change in money supply divided by the change in monetary base. Change in monetary base. Then guys, we spoke about we spoke about the determinants of money supply. First view beta is that the central bank beta will decide apni marzi se without considering any other variable. The other one beta is by considering the impact of other variables. Right now guys, when we talk about determinants of money supply beta, there are 3 important determinants of money supply. One is high powered money beta, the other one beta is the ratio of reserves to deposits, the third one is ratio of currency to deposits. Ratio of reserves to deposits, ratio of currency to deposits. This basically beta is derived from the behavior of the central bank, behavior of the banking system, behavior of the public. The behavior of the central bank beta can be very evidently seen beta through changes in monetary base. The RBI beta can directly change the money supply in an economy guys by changing the monetary base. If all the other factors are constant as such guys, the change in money supply will be multiplier times of change beta in your monetary base. Likewise beta, if you talk about behavior of banking system, remember guys, the banking system is required to maintain certain minimum reserves beta called as required reserves with RBI as such guys. So this higher the required reserve ratio beta, lesser will be the multiplier, lesser the required rate of reserve guys, required reserve ratio, higher would be the multiplier. RBI can directly affect the money supply beta by changing this required reserve ratio, by changing the required reserve ratio as such guys. यहाँ पे क्या होता है beta is basically the banks beta might actually hold more reserves beta than the amount of required reserves ratio. The banks can actually hold more reserves beta than the amount of minimum required reserves guys. This is because beta the banks, if the prevailing interest rates are low beta, the opportunity cost is low, the banks might not want, you know guys, mind holding excess reserves. However, if the bank is expecting an outflow of deposits, they will obviously want to maintain a higher amount of cash reserves guys, so that they can meet their cash balances, cash requirements. Third reason beta is if they are sensing a lot of high financial risk in the market beta, then they will not want to lend money. They will be they will be sitting on a huge pile of cash but not deposit that, but not lend that money guys. So higher the amount of excess reserves, lesser will be the multiplier ratio. Higher the amount of excess reserves, lesser will be the multiplier ratio. The third one beta is the behavior of public, which is determined by the ratio of currency to deposits guys. A lot of people beta might want to hold currency and not deposit that with the bank. If they're not depositing that with the bank, the multiplier effect will not work beta as far as the currency that is held by the public, guys. This in turn beta would depend upon the financial inclusion in the economy guys, the growth, technology, innovations and all of that. But guys, higher the amount of currencies that people hold, lesser will be the multiplier effect. Okay, sir. So ultimately, but I've derived the formula of multiplier. I told you if there is currency to deposit ratio, if there is minimum required reserves to deposit ratio, if there are excess reserves to deposit ratio, multiplier beta would be 1 plus C divided by C plus E plus R. Multiplier beta would be 1 plus C divided by C plus E plus R. That would be your multiplier. Understood, sir? ठीक है, हाँ sir. I gave an example. Then, but I told you that RBI beta through its monetary policy can always influence, stimulate the economic activity beta. If they are increasing the monetary base, guys, money supply will increase. If they are decreasing the monetary base, money supply will decrease. That can be done through open market operations, purchase and sell of RBI securities beta. Government can borrow beta through ways and means advances from the RBI beta to, guys, compensate for the mismatch of receipts and payments. When government is spending this money beta, they are infusing money into the market. Through the multiplier effect beta, the money supply will increase. The money supply beta will increase. Are we all clear about this? Yes, sir. We are clear about this.